Right, hello and welcome back. I had a bit of a mare in the time off. I know I said at the end of the last video I'd go away and I would work on sorting out the comps in the spreadsheet so we could just look at the cover page and read through them. Well, I did that and then I ended up deleting everything that I'd done, and it took me back to a version of my spreadsheet from ages ago. So it took me a very long time to let's just open it in this a minute. It took me a very long time to get back to rebuilding the spreadsheet back to where I want it to be. So we've now got the comps. They should all work in here. This is basically, pardon me, this is basically just comparing apple to apple to apple, just so I can make sure all my figures all lined up. I've also added in a book measured and tangible book measured compounded annual growth rate plus dividends, because from what I've read, if you were to own the whole company, that is how Warren Buffett would calculate the return on his investment. Obviously, the growth in the book value, or I've got tangible book value as well here, which is what I've actually put on the front page because it's tangible, but also, so the growth in book value plus the dividends that it pays you is how he would supposedly calculate his growth rate for the business. So, as you can see here, Apple for the last 3 years had been compounding with dividends quite well. Only reason I got Apple up is just because that is the company that I use to check all my spreadsheet and all the comps pages and all that to make sure everything was lined up, and then I've ended up conditional formatting everything. But yeah, it took me a lot longer and was a lot more stressful than I wanted it to be. But there we have it. So I think what I'll do is we'll just crack on where we would normally crack on and go down through this list and see what we can find. It's very annoying, really, because I would like to go down through this list and have you see it, but maybe I should rearrange how this page works. This spreadsheet, quick take spreadsheet works because when you want to figure out what the business does, well, I suppose it's just a case of up and down, isn't it? But I already know I'm not going to bother looking at this one because it's got bio in it, and that is not something that I'm remotely interested in. CWBC. Let's have a look. Okay. Enterprise value, so it's clearly a bank, I would imagine, yeah. Community West Bank shares. California. Yeah, I'm not normally overly interested in banks. Simple free cash flow, 10 million a year. If you were to buy the company, is not really earning, there you go, 38 years it would take to buy. Not really something I'm interested in. The chart on it, I think actually, if you would have bought it, looks quite impressive. There you go, yeah. It's done very well since June last year. I don't know what the catalyst would have been for that. What's it, CWBC? We're just wasting time here now. What am I trying to do? That won't open. Technical analysis, look going on here. Why is that lost? I see. What was it? CWBC. Sure. Is that when all the community banks, was it SoftBank? That's COVID. And then post-COVID, wasn't there like a banking scare? Down at lows all the way up to, where are we now? Yeah, 87% return. You had over 100 at some points. It's a healthy trend. Well, was a healthy trend. Technically, this is how they say that you'd determine whether or not something's healthy, but there's no real, anyway, technicals. All right, what's next? What's smart trend? Because that looks awful, which is sometimes what we're looking for, oh, I got the wrong spreadsheet open. This is the UK version. Is this the UK version? Yes. Okay, got the wrong bloody spreadsheet open. That one there then. There we go. So basically everything I just put in about that banking one was completely wrong, because that was half of what it should have been. Because in the UK, we only release financial statements every 6 months, which I think is wrong. I think it should be quarterly. I think it's much more beneficial for investors to know quarterly compared to annual, well, semi-annually. But there we go. Is it CWBC? I'll just put it into this one in a minute and I'll show you what the different. There we go. So it's twice as good now, 15 years instead of 30. But still not really something I'm interested in. 24 million in simple free cash flow. I don't know. I know Warren Buffett likes investing in banks and does it reasonably regularly, but there's a lot of stuff in banks that it's difficult to quantify the value of from what I've read about and from what I've seen myself when I've tried to value them. I wouldn't say that I wouldn't do it all the time, or at any time, but yeah, I did look at a couple after that banking crisis, like in the early days of me trying to figure out whether or not I potentially knew what I was doing, which I still don't profess to know now. I do not think I know what I'm doing at all, which is why I'm doing this, and hope I can connect with people that will help me learn, network as it is. And I'm just vlogging my journey for anybody that comes across this video who hasn't seen any of the other videos. And I do not know what I'm doing. I'm trying to build my first portfolio from no experience, no education or anything. I've self-taught myself everything that I know or don't know. And this video series is just basically a vlogging of my journey to hope that I can network with some people that will help me learn, with similar interests. I'm a value investor. Even though I started off with technical analysis, I am a value investor. It's the only thing that I truly believe the value comes from. But yeah, so I'm just vlogging my journey. And if anybody wants to ever watch it and chime in, please do. One day I hopefully will be live streaming as opposed to doing videos. But summer holidays at the moment, kids at home, it's not made it very easy to do live streaming. So yeah, that's where I am. I do not know what I'm doing. Do not copy me. But if you would like to network, please, and not just network, right? If you want to tell me I'm wrong, I need to know that as well. Like, I got no qualms in anybody saying you're a fucking idiot, you're doing this wrong, because I need to know how to do it. Otherwise, I'm not going to succeed in this. And this is something that I would like to do, So there it is. Again, this bank, not interested in. Just seems a bit too expensive for everything. What were we on? SMRT. Quick take spreadsheet. SMRT. Oh, I got in the wrong bloody one. SMRT. What have we got here? Okay. Negative free cash flows. That's why some of these are negative. Wow, that's not good, is it? 1 year of positive free cash flow. This is not my simple free cash flow anyway either. This is Y Sheets. I use Y Sheets for my data. This is Y Sheets interpretation of simple free cash flow. There's a couple more things in my main spreadsheet that I take out. Stock-based compensation, and I can't remember like any one-time gains or anything. But this is just look, it is what it is. Quick take spreadsheet. But yeah, look at this. This is not good, is it? Current liabilities are all right compared to current assets, so not going anywhere anytime soon. But yeah, return on capital severely negative. What did I even do? Software company. Not for me. Not for me. Not with this. It's dire. Which is obviously reflected in the stock price. Not that we can see it. I'm going to have to drop this on the other screen a minute. Awful. This company ain't going anywhere within the next 12 months, not according to the current assets and the current liabilities, but it does not have a history of being able to prove that it can do anything. Look, in the whole 5 years that I've got it on here, simple free cash flow of 1 million once. It's not Not for me. LNW, what's this? Light and Wonder. See, that's a significant sell-off when you look at the trend that was going on before that. That's interesting. What is it? LNW. 20% return on capital. 50% on EBIT. Okay, we could draw this in time. Oh, I don't like that. Tangible book, negative $44. There's awful lot of goodwill on this one then, I would imagine. 4 billion in goodwill. And total assets, Jesus Christ. 2/3 of total assets are goodwill and intangibles. Generally not something I like to see at all. 266 million simple free cash flow. 10 years with it, yeah. 10 years to buy itself on EBIT. Much longer on simple free cash flow. Return on capital I like. You know, technology-based products and services related for content, gaming, lottery, social and digital gaming industries in the United States and internationally. Yeah, can I drag that a bit smaller? Yeah, a little bit. Just to bring more of this into play. Yeah. Okay. LNW. Wow. $5 in 2020. Look at that. Look at that for a return. That 20 bagger. Let's not go from the lows because you'd have to be very good to go up there. 16. Whew. You'd have got in on that, look. How many days? 5 years, yeah. 4 years. Wow. That would have been a play, wouldn't it? Look at this. There's some huge swings in this. Got consistent, sort of like popping out. Technical analysis again. Look. Fundamental investor using technical analysis all the time. It's nothing really. Okay, interesting. You know, this is good. 20% is quite good as well. Got a funny feeling one of Lee Lu's investments was much less than 20%, and it like 5-6 baggered it. That I do not like though, as I've said. Maybe we'll draw this one in quickly, just have a quick look. Going back to, I'm going to delete all of this now, aren't I? What was it? LNW, wasn't it? Yeah, that's the one. So what I'm going to have to do in a minute is delete all of this out of the comps. Ooh. And out of here. I don't need to delete out of there, do I? Let's get rid of Apple here. Could have done this beforehand. Let's show you how inexperienced and rookie I am. But to be honest, I don't particularly care because I am simply doing this to learn, and you're just getting a view of how I would be going about my daily business. So if you want, you know, if my goal is to see everything, there you go, just seen it. Right. Put it in the cover, haven't we? Yeah, $88. Jesus, that's a... Oh, Jesus, look at the simple free cash flow margin. This isn't as good as it looks. Operating margin, 20%. Now, one-off year. Grown significantly from here to there. I bet we'll see some acquisitions if you go down to Goodwill. How many years ago was that? 4. On the balance sheet. I'm going to sneeze. Maybe not. Goodwill stayed. Oh, me. Goodwill stayed reasonably consistent, so I was wrong on that one. Long-term debt. Got a lot of it out back there. How high it was, and compared to now, I mean, it's slowly creeping back up again. You've increased by 900. What's that? 890 million. There's not really a lot in here that I like, though. Not from this. Interest coverage of 1. Only just got enough cash on the books to cover the interest. What do I take that from? 71, 68, 71. So I take that from simple free cash flow. Yeah, it's not great. Interest coverage of 1. Only just earning enough simple free cash flow to cover the cost of the interest. That's saying interest expense 288 million. What's simple free cash flow? 320. So yeah, we're going to say no to this straight away. The return on capital is historically very good. One really bad year here, simple free cash flow is probably negative, was it? This year, yeah, there you go. That's why that's happened. There's not a lot here, though, is there, really? Actual cash that they're generating is not good. Yeah, just enough to service what's potentially next year's interest or whatever it is. Revenue growth, so that would have been, although what have you got there? Gone down from lost 700 million and then almost gained some of it back, you know. Now we're back in the same territory again that what you were back in 2021. Just wasting our time on this one, so this one's going to go. Going to move on. REITs. There's not enough data on that one. September, not for me. I'm learning REITs. So I know a few value investors and all that say that they won't invest in REITs, but when you read a lot of Michael Burry's early stuff that he had these MSN articles, I think there was 2 REITs in there that he invested in that time. So Michael Burry is one of my investing heroes. Joel Greenblatt, Monish Prabhai, Lee Lu, like Howard Marks a lot as well. Not that there's a lot of information out there about Lee Lu, but from the small bits that I've read, I like him, you know. Obviously, you got Warren Buffett, Charlie Munger, but as a value investor, that sort of goes without saying, I suppose. But yeah, Michael Burry doesn't shy away from investing in REITs just purely because of that. It's a business that I'm trying to understand and trying to learn, you know, literally just because of that. He made some decent money in REITs and they've got an obligation, I believe, haven't they, to pay out a certain amount of their earnings in dividends. So it's always interesting. Although I got a funny feeling in the MSN articles, the REITs that he'd invested in will just come out of bankruptcy, so they had no debt. So obviously it's good business at that point, because I think the problem with REITs is they're incentivized to just keep buying, and then I think that bites a lot of them in the ass when you know, the maturity dates and all that come in. No data on that one. Is this Focus Universal? FCUV. Never heard of it. FCUV, what do they do? Awful. Jesus Christ, I'm not even going to bother looking at what they do. Negative simple free cash flow, negative operating earnings, just everywhere. Red everywhere. Goodbye. So I see these have come up. I swear these have come up before. Not that I think we've looked at them on the stream, but I've definitely seen this company before. Want me to tell is sometimes I put flags beside them. No, I haven't done it. Jesus Christ. Of course, you know. I've definitely seen this company before. I said one way, if I think a company's dog shit, I will just red flag it. So when it comes up again, it'll have a red flag beside it on the watch list, and then that'll be it. Done with it. Doesn't mean fundamentals can't change though. You've always got to keep an eye on that. What are we looking at? Oh, a sand. So we do want that back up. Let's see what's going on with this one. Negative. If this is correct, still loading by the look of it. Positive there, so negative. Look at this, severely negative simple free cash flow, severely negative EBIT. That's why your years are negative, because the what's it called negative, I believe. Return on capital minus 91%. How has it ever got up this high then? Because we're close to all-time lows again now. What did it even do? Work management platform for individual team leads and executives in the United States and internationally. The company's platform team. Do you know what I'm going to do a minute? Let's get this up. Below it, no. I'm going to change that. So drag that all down there. That needs to go with it. And then I'm going to change this a minute. Edit it on screen and do it. Oh God, what have I done? Drag down. What is going on there? Okay, maybe I have to do this another time. Let's control edit all, get it all back to where it was. Do that another time because I'm not wasting the stream time doing that. I just wanted to make it smaller so it'd all drag down here as opposed to having the. I'll do that another time. Write it on the list. Not really something I'm interested in. It does not look like a particularly good business, does it? Again, Lumen Technology. Wow, that's nice. Look, Jesus. Got to stop saying Jesus. I apologize. Holy moly. Look at that. Right away down here. Bad earnings, and yet it's still. I don't really know what these do. Look at that. 500-600% in 6 months. Even to where we are now. Almost 300%. And essentially looks like there's still an upward bias to it. Here, look. All right. Put it in a quick take spreadsheet. Nice if you can get them, look. 6 months. What has done that then? This is worth looking into. Look at this huge jump in simple free cash flow. Now let's look into this one because you don't see this every day. Phenomenal. Phenomenal. All right, let's drag that one up. Where were we? Over here. Get rid of all this. Another one. No. Delete. Drag it in. LUMN. Get data. All right. Go to cover. LUMN. Facility-based technology communications company provides various integrated products and services. And let's just delete this one as well. Lumen. I have heard of Lumen, haven't I? Company operates in two segments: business and mass markets. Operating VPN, Ethernet, Internet. Company served approximately 4.5 million broadband subscribers. Yeah, Lumen rings a bell. Might not. I mean, there could be another company in this country called Lumen. Tangible booklet. Look at that. It's severely negative there. 2020. Dragging it in. Simple free cash flow margin is not great. Look at that. 2022, huge. It's like a COVID boost. That's generally what I always think when I get to look at a company, and then they've gone from, 2020 really good and then decline. That's why the 18% drop in revenues, 12% drop, 6.5% drop, probably where the decline in prices come from. And not only that, the actual underlying of the company got worse as well, at 56 down to 44% on gross margin. Costs have ballooned, 5%. There's no book value at all though, look. Revenues trading just over my revenue thing's wrong, I think. But like I said, I've had to rebuild some of the stuff. I know all this data in here is correct. Some of these multiples might be wrong. I might have to go and have a look at them. Yeah. Wow. 12 billion. There you go. I think that's correct. I have been reading that I shouldn't be doing EV multiples on some of these. I should be doing it more on the cash flow. I don't know whether or not this is correct. If anybody watches this and fancies commenting, let me know. But apparently EV multiples should only be done on like earnings sort of stuff, cash flow, simple free cash flow, EBIT and all that, not on actual like book values and all that, because supposedly you've double accounting, because obviously in order to get a book value or tangible book value, you've already subtracted the debt and the liabilities from it. I don't know whether or not this is true. So, something I got to research and look into. I only came across that last night, to be honest. So it shows you my level of experience is very low, if that is the case. Because if people ever watch this, they'll be like, "Yeah, you're an idiot," and that is correct. So if it is, let me know, and then I can change these. I don't like this though. Like in a fire sale, you had to sell the company, you ain't getting nothing, are you? Because there's nothing left. Liabilities are obviously greater than assets, and the assets are 4 billion in goodwill as well. No one's paying for that. 6 billion in goodwill. Oh, so that's even wrong then, isn't it? That's not correct. Goodwill and intangible assets. How have we got 6 billion in goodwill there? And goodwill and intangible assets of only 4. So it's, you'll keep an eye on the data sometimes. For the price, there's no better data out there that I found anyway. Y Sheets is full of prices. It's phenomenal, but you just got to keep a bit of an eye on it to make sure that it is correct. Because in this instance as well, look at that, go to 2 billion, 6 billion. Let's have a look. What is it? Lumen, SEC. Let's have a look. Latest 10Q. Just do it on the interactive data here. Normally I will open up the whole thing. Financial statements. Oh, wrong one. Consolidated balance sheet. Goodwill 0. Interesting. So they got rid of their goodwill. So that can be 0. In fairness, right, I'm not a big fan of goodwill because obviously it generally gets written down as potentially what's happened here, so it's disappeared. It maintained it, if data's correct, for a while. Oh no, it didn't, because I'm sorry, we should be looking at this bit. So it didn't maintain the goodwill. My mistake. Jeez, sorry. I'll have to learn to change my surprise language. 30 billion in goodwill, down to nothing. Yeah. That's why I don't like goodwill. I can't see that being anything other than it's been written off, which means they've made some really bad investments. Generally speaking. Yeah, I was going to look at the balance sheet when I... 33 billion in total liabilities, total assets 32. I mean, this long-term debt's obviously not coming due all at once. Short-term debt, 606 million. Cash, they can afford it. Not too bad, is it? But, you know, if you were to, let's say, fire sale the company, in the worst possible case, liquidation value, you're going to have nothing, are you? Because there's not enough there. Not remotely enough there. So, you know, from what I've heard Monish Pabrai say, that's, you know, he wants a good liquidation value. He wants to know that in the worst possible case that he's not going to lose any money. And here, in this instance, your liquidation value is going to be less than 0, potentially, because obviously I believe this is all held, like property, plant and equipment and all that's all held at cost. So it doesn't take into account the potential for, you know, prices to go up on property or on any equipment. Generally prices, I'm an engineer, so in my experience from my actual work, prices on equipment doesn't ever tend to go up because it wears out, but property is obviously very common. Everyone knows that prices of property generally go up. The idea that they're going to keep going up and go up forever is obviously what caused part of the reason for the 2007 financial crisis. Part of the reason everyone just assumed that the good time was going to last, which isn't the case. Doesn't always happen, does it? But yeah, if that's held at cost, it could be worth more depending on what their property is. You know, it's quite a big portfolio, 18 billion in property, plant and equipment. What's this technology company, did it say? Facilities-based technology and communications company. All right, let's get ChatGPT to explain it in layman's terms. Explain Lumen. How do I do that? Business model. Oh, how it makes money and how its revenues are broken down. Now, if you've not watched any of my previous videos and you've made it over half an hour into this one, started asking ChatGPT quite a lot of stuff because it's easier than trying to find it in the reports and everything. You can get it, as you've seen here, generally very quickly. So it doesn't mean that everything's right. I have pointed out to ChatGPT a few times that you're wrong on that. It's not what it says. But for a quick overview of stuff that you'd want to know, ChatGPT, you can get it up almost instantly. Formerly, I can't even speak. Formerly CenturyLink. I've heard of CenturyLink, yeah. Probably seen it advertised in bloody NFL games or NASCAR or something. Lumen is a US-based technology and IT services company. We know that. And it generates revenue through a combination of infrastructure and connectivity, managed and IT services, legacy telecom offerings. Its core businesses include high-speed fiber and copper-based connectivity. So do they own the assets? That's the thing. Cloud managed services, hosting, cloud, big data. I'm guessing they probably do. and you're looking at the sort of thing that they're in. Broadband internet, fiber, copper, legacy voice and network, standard traditional wireline phones. Okay. Telecom IT. Lumen also monetizes via indefeasible rights of use, long-term agreements, often 20 years, granting exclusive use of fiber capacity in exchange for large upfront payments. Interesting. This is particularly common in infrastructure deals tied to data center and AI-related activities. Interesting, because that's guaranteed income for potentially 20 years, I'm guessing. Recent strategic moves include heavy focus on AI infrastructure. Okay, revenue breakdown. I mean, one of the things Bonnie Prabhaya and all that say, Warren Buffett, is you got to understand the business. This is bordering on semi-confusing. I generally believe that if I do enough research, I can understand anything, but it's just whether or not you want to dedicate the time to understanding it. By customer segment, full year 2024 results, business enterprise segment. What's the business enterprise segment? Have they said that up there? There we go. High-speed fiber, copper-based connectivity. Okay. Mass market segment was this one here, broadband internet. So, okay. Phone lines, internet, down 8%. I don't know why they've crossed this out. This means total revenue in 2024 is approximately 13.1 billion. Business segment account for about 79%, and mass market is 21%. Wow. So they've got all these so-called segments, and yet everything's coming from two of them. By product category, annual breakdown, growth emerging areas like dark fiber wavelength services, down 3%, down year over year, down. Stock price, down. There you go. Where were we? There. Quarterly snapshot, 12% year over year decline. This is what's going on there. So they got no asset value because of the debt that they hold. They have assets, obviously, and those assets have a value, but the money that they owe is significant. It's not worth looking into, I don't think, just from that point of view. You owe more than what the business is worth if the business was to go bust, and your earnings are down. Everything's down. So this is a business currently, I wouldn't say struggling, because they are positive on things, aren't they? Just, but compared to where they were, even post-COVID, like 8%, 9%, 12%, simple free cash flow margins down to 1%. This is 3-year average as well. So what are they currently? Simple free cash 7%. So it's got better. So you've gone negative. That's why you sort of got to keep a look on all of them. Long-term trend, not good. One-off year, it's returned significantly. What has caused that? Let's look on this. Is this the Lumen one? Yes. Cash flows. Capital expenditures. How's that positive then? Proceeds from sales. How is that positive? Oh, it is there. Sorry, I'm being an idiot. Well, that was a bigger number than that then. Yeah. That bodes well, doesn't it, for people watching? Stock-based compensation, 22 million. Not cool. Goodwill impairments, 700 or 600 million. Yeah. There's not a lot here I like, to be honest. Like my simple free cash flow, I would have thought should be negative because I take out stock comp. Or it should be, what, positive by 1 million? And what have we got? 7%. So something's not right in my 68. B17. Have I done this wrong? Have a look. 17. Let's make this bigger. Seeing all my fuck ups in real time. Look. Quarterly. Let's get the graphic calculator out. 4385. Is this data right? 570 million Q2, or is it just not updated? Am I looking at the right company? Lumen. C double prime's not good. Look, grey area. Is the data wrong again? Am I looking at the right company? Cash provided by operating activities 6 months. Oh. So in the last 3 months, nothing? What is going on here? That's interesting. Lumen's latest NQ, a significant cash flow statement, data missing, why? That's on the SEC, that's the SEC filing. Or have you just got to deduce it yourself? That's what has happened, I think, isn't it? If you went back to the other one, let's write that down a minute. See, 166.5 million, that is. Go back to the 10Q before. Financial statements, cash flow. What's fishy going on here? Look. Millions minus 1095 left you with 570, which was correct then. So Y sheet is correct, isn't it? Yeah. Why not show it in your? Interesting. What's, I don't know. You want people to invest in you. It's a relatively confusing way to put your statements out, isn't it? Yeah. All right. 6 months. So in the last 6 months, I'm getting confused again. This is me showing my experience. 6 months, yeah. They are highlighted 6 months. This ETM 12 months. So yes, it could be, obviously could be positive. Yeah, okay. I don't really like it. The whole liquidation value offering you nothing if everything goes wrong. Don't like it. The business looks like it's got better, doesn't it? TTM 6-7%, simple free cash flow margin, negative returns on book value and on dividend. Look at that. What's the point? No point even paying a dividend, is there? Do they pay a dividend, or have they suspended it? Possibly suspended it. Did they pay a dividend? That's there. They did, yeah. Suspended it a few years ago. Do they have third? Cancellation of term loans. don't know, wasting time on it. I don't like it. This is lovely, 2024, but in 2024, sometimes it's helpful to diagnose previous stuff to see what changed, you know. But still a drop in revenues, drop in simple free cash flow margin. Return on capital became positive. Oh, what am I doing? Don't do that. Return on capital became positive for both simple free cash flow and EBIT. Okay. EBIT positive. This is probably what's caused it. EBIT positive. Simple free cash flow positive from previous years negative. How fast did that fall off a cliff? Oh, it didn't. Oh, it did. 2023. Look at that. He's properly fell off a cliff. Wow. Weekly. Imagine being up there and holding. Anyone hold it? Not that I don't like it already. I already don't like it. See if anyone smarter than me, which is basically everyone, to be fair, sees anything in it. Any other investors that I respect? Not by the look of it. Ownership percentage of portfolio, anyone? No. No one. They're short anyway. Look, short. Yeah. Moving on. Don't like that. Bridgewater Bank shares. Not really interested. Big spreadsheet. What was that? BWB, wasn't it? Yeah. BWB. Another bank C, so enterprise values. What I found, amount of cash and assets that they hold generally would have a negative enterprise value. Let's just ask that actually. Get rid of this one, new chat. Is it reasonably common banks to have a negative enterprise value? It probably is. No, it's not common, but it can happen. Let's break it down. Market cap plus debt. For non-financial companies, EV is a useful measure because it reflects the total value of a business. Non-financial companies, here we go, see, including both equity and debt adjusted for excess cash. For banks and financial institutions, though, EV is trickier because debt is actually their raw material. Yes, that is it. So you give them the money and they invest it, I suppose, look after it, but they still owe you that money. It's your money. Cash and equivalents are core to operations, not just excess liquidity. So market capitalization is very low, often because investors think it's distressed, insolvent, or facing losses. It has large cash or near cash reserves, which is common, but if market cap collapses, those reserves outweigh it. Yeah, I see this. Yeah, I understand. Small trouble bank whose stock prices collapse during a crisis, regional bank turmoil, bank trading below book value, but still showing high liquidity. So what was it, BWB? Is it trading below book value? Because I've got one of them down here. No, I haven't. Favorites, price to book value. 1.6 is trading around about book value. 1.06 was trading below book value. Down here, look. I seen on a different investing YouTube channel before that they were saying that, you know, banks historically do very well if you invest in them below book value. Like, oh, pardon me, your returns, which would be, you know, so if you're below book value here, let's drag that up a minute so we can see it better. I don't want it. There we go. So what are we down here at this point? 75% of book value. We're here, look. So if you would have invested that to now, which is around about book value, is 100% return. So yeah, I get it. Makes sense on this bank anyway, specifically this bank. Yeah, interesting. Maybe that's something to keep an eye out on. I said previously, banks and all that generally, it's difficult to understand what they're holding. Yeah, okay. Interesting. I mean, I don't, 6 years worth of data, 7 years worth of data. That's like on my, wow, what would my limit of data be from everything that I would say so far, from my limited experience? I'd want at least, I definitely want at least 5 years worth of data, and I probably, ideally, would like 7. So we're like now on, you know, something I would deem has probably got enough data. Up here, like, we were trading well above book, so no wonder the 1.6 times book down to, you know, 75% of book. Yeah, interesting that actually. Look, we've just seen that in real time, what those people say in real time. You've seen that, you know, potentially can work. Look, total debt 500 million, current assets. Okay, you know, it's not bad, but based on the buy it below book, which is something I believe Warren Buffett says as well, that banks, you sort of need to, I'm sure he said that you've definitely got to view them as their cash flows, because as you do with any business, but I'm sure I've read that Buffett believes that book value is very significant to banks. So yeah, you know, in this instance, when would that have been? When would you have held that? 2023. So that was during that crisis again. Like. So in, what's that? Year and a half, 18 months, 91% return. Yeah. Well, there we go. Dividends as well, I would imagine, with a bank. No dividends. Okay. So that would have been it. But yeah, 91, 92, 93, 94% return. Interesting. Want to keep an eye on that then. You know, if the bank, I would imagine, right, this is just me now thinking out loud, I would imagine that you would have to make sure the bank's not at risk of going bust, and then you can rely on, you know, the ability for it to, its book value to increase again. Yeah, all right. Sorry, I was just sending a text. Keep going. Bell ring brands. It's a decent return as well, like from this time last year. Double, 100%. BRBR. Wow, look at this. It's markedly different from Simple Free. Oh, is it? It's not markedly different, but it's definitely different from Simple Free Cash Flow. Return on capital. Current assets, current liabilities. Looks pretty good, doesn't it? Revenue. Trade in twice revenues. Tangible book value negative. Struggle with that. Total debt billion. Total, oh, there we go. Look. Total debt. So I got that will be just short term and long term, I believe. Was it BW? No, not on BWB, are we? What were we on there? Bellring, wasn't it? Bellring brands. BRBR. SEC BRBR. Come on. Decided to have a temporary unavailable. Interesting. Here we go. All right. Internet was just having a poor 5 minutes. Let's have a look at the... it's doing it again. What is going on? Is it the SEC page or is it all of them? Statement of operations. Nope, wrong one. Balance sheet. Total assets, long-term debt of $1 billion. Wow. Yeah. So already really we're on the potential for the Monish-Bry framework, in that you want your liquidation to cover your nutrition products. So ready to drink share. See, this is another thing. It's potentially a bit of a fad industry. It's either in or it's out. I mean, definitely looks like it's in, but yeah. 25, 24, 23, 22, 2020. Boom. There you go, look. That's because everybody during COVID, potentially, although the revenue didn't change much, is the revenue's better now than it was back then. Well, it went up 300 million, 200 million, almost 300 million. Yeah, all right. Moving on. No chart on that. No chart on that. Miami International Holding. What's that? Airports, maybe? Mayax? What else would it be? Nothing. I haven't even got. Oh, they have. Oh, cash and equities. No, not interested at all. These people clearly are. Rockefeller Municipal Opportunities Fund, not interested. Eco Lab, probably not in. Ooh, what do they do then? Anything with lab in, normally I just think, you know, wrongly, possibly, bio or anything like that. Supplement, ECL. Good returns on capital, simple free cash flow, and EBIT to EV is not great. Profit margins are reasonably slim. Water hygiene, infection prevention sources, United States and internationally. 1923, so it's over 100 years old. So it's no, you know, it's been around. Don't like this though. 1.5 million in simple free, 1.5 billion in simple free cash flow. 79 billion or 79.5 billion to buy the company. Right, where are we there? I mean, people like it. Look at that, 160, just over a year, 160 to 251. Don't know what's caused that though. This, I would imagine. I don't know. Because we're down now. We're down on this. $280 times no tangible book. Goodwill and intangible assets of 11 billion. So close to half. Don't really like that either then, to be honest. Valvoline. Triple V. See what they come up with. I don't think in all the videos I've put up yet, we've actually found anything that I've 100% deemed worth investing in. The only one that I'd liked was this one. Even then, it was only a week or two ago. It's not a huge increase, is it? And I believe that the increase was only marginal, didn't I? You know, Fabri, Lilu, Greenblatt, they want returns that are going to be outsized, you know, huge. If you said to Monish Fabri here, I can give you 20% over 5 years, I'm pretty certain he wouldn't take it. Because they'd all state that there's better investments out there. Let's have a look. Triple V, we got that up. Return on capital, very good for EBIT, operating income. Return on capital for simple free cash flow is not good. 22 million. Look at that for a decline in simple free cash flow. This is on Y-Sheet's metric as well, not on mine. It's all but disappeared. All but disappeared. 200 odd million, 173 million, 153 million negative last year. Probably some big capital expenditure, maybe. 22 million this year. I mean, the stock price has obviously gone along with the decline. What have you got? So say, what's that all-time high? It is an all-time high. 20% upside if you can reach an all-time high. At the moment, price seems a little, you know, stuck around this level in here. Again, probably a moving on. Anybody holding it? I mean, I have a list of all the things you need to understand about business if we're going to look seriously into it. But 10%, 10% owners. Just under 10%. Percent of their portfolio, 10%, 8%, 5%. So this is people with reasonable conviction, you know, to do dividends. No. Pardon me, yawning. Yeah. Negative working capital the last couple of years. Simple free cash flow, 22 million, 5 billion. How long it take you to buy the company out? Market cap. No. All right. I'm just going to have a quick break a minute and we'll move on to mortgage trust. Interesting. Looked into them before though, and it wasn't really a type of business that I liked, I don't think. Really understand how. Is it a mortgage REIT? Let's have a quick look. GPMT. GPMT. Real Estate Investment Trust, yeah. Just ask this question here. How does a mortgage REIT work? Very difficult from equity, very different from equity REITs, yeah, because equity REITs own the physical property. Mortgage REITs is a type of real estate investment trust that doesn't own property. Instead, it invests in real estate debt, things like mortgages and mortgage-backed securities. They earn money primarily through the spread, the difference between the interest income on their mortgage asset and the cost of financing those assets. So mortgage REIT might borrow short term at 3%, then buy a pool of mortgages yielding 6%. Okay, so they get 3%. Okay. Significant leverage, 5 to 10 times their equity to amplify their returns. So that's not good. Types of mortgage REITs: invest in mortgages guaranteed by Fannie Mae, Freddie Mac, Ginnie Mae. Never heard of Ginnie Mae, heard of the other two. Lower credit risk but highly sensitive to interest rates. Invest in mortgages without government backing. Mix of both. Risk: interest rates of borrowing costs rise faster than mortgage yields, spread shrink. Yep. Prepayment risk: if owners refinance early when rates fall, REITs lose higher yielding assets. Yeah. Heavy borrowing magnifies both gains and losses. Yeah. Stress market 2008, 2020. Repo lenders may pull back, forcing REITs to sell assets at a loss. Yes. By law, REITs must distribute at least 90%, there you go, of taxable income. Mortgage REITs often pay very high dividend yields because of their business income focused rather than growth focused. Okay. Mortgage REIT is essentially a levered investment fund for mortgages, making money on the interest rate spread. They can deliver big dividends, but they're very sensitive to interest rate swings and credit market risks, credit market stress. Yeah, so times of high interest rates, people's going to default on their mortgages, and that's going to significantly affect this line of business, just like, 2007, 2008 financial crisis. All right. Now we've learned that, I'm going to have a quick break and then I will come back to you. So I'll see you in a second. And we're back. Right, where were we? Insider purchases. Were we going to look at that REIT or not? Was it there? Was that one? GPMT. Yeah, after Valvoline. Right. Oh, look at that. 197. That looks cheap. See what we can do. Do we have a look at it or not? GPMT. Ooh. I wonder what's caused a loss in that then. Still looks a bit strange though, doesn't it? It's not picked up the data. Wonder why that is. Just have a quick look on here. See if it's pardon me. See if there's anything going on here. What would that have been? What was I trying to calculate there? Liabilities and all that's missing some balance sheet. There's stuff there. Do I like it enough to... Don't know, let's have a look. Loans held for investment. What's this in thousands? 1.8 billion. It's a big one then, Jesus. Allowance for credit losses. Take it that's when people aren't paying back, so they're not going to get the full mortgage. Loans held for investment net 1.6 billion, because that's in thousands. This is a big old mortgage trust, isn't it? Cash and equivalents 85. Repurchase facilities. I don't know what this means. Amount including accrued interest to be repaid to counterparty to purchase agreement and carrying out market. Okay. Total liabilities 1.3 billion. Total assets 1.9 billion. So the book values there. Obviously it's mortgages though, so there's no asset value really underneath it. You can no properties or anything. That's what I'm trying to say. Statement of cash flows. Let's have a look. Net loss 20.3 million. Originating acquisitions. Proceeds. So what would be capital expenditures on this then? Probably this one. When acquisitions, additional funding and loans held for investment, net deferred fees. It's probably going to be that, isn't it? Proceeds from repayment of loans held for investment. Okay. this, I don't know. Do we ask Google AI or Chat GPT what will count as expenditures for a mortgage REIT? Let's have a look, just see if it can tell us quickly. Wasting a bit too much time on this, but we're learning. Capital expenditures for a mortgage REIT. Okay. Money spent on acquiring, improving and maintaining physical assets. Mortgage REIT doesn't usually own property, so it doesn't have the traditional kind of capex you'd expect. Its assets are financial instruments, yes, which are investments, not capital assets. So when a mortgage REIT buys more mortgages or MBS, that is recorded as a purchase of investments, not as capex. Is that what we're seeing? Acquisitions and additional funding of loans held for investment. So that would be the capex, I take it. Now, okay, let's ask that, because obviously every single time, not every single time, but the two on the screen, operating cash flows doesn't even come close to covering this, but the net cash provided by investing activities is huge, see? So simple free cash flow is going to be a bit different to calculate with this. And then they've got to give 90% of it away. Principal payments on repurchase facilities. Alright. Mortgage REIT is essentially a levered investment fund. Yeah, okay, we got that. Where are we? CapEx is basically just corporate overhead investments, not the acquisition of mortgages. What am I trying to ask here? Pardon me, hiccups. Net cash provided by I would keyboards. There we go. That's right. Keyboards balanced on top of stuff. Why would net cash from investments be so positive? Does the what would you call it, income appear in the investing section due to the nature of it? Cash flow statements as operating activities, normal business cash flows. Investing activities, buying and selling long-term assets, most companies, capex and acquisitions. Finance activity, mortgage REITs, treats mortgages more as investments. There you go. See, so when they buy mortgages, MBS has a cash outflow in the investing section. There we go. When they sell mortgages, MBS will receive principal repayments as a cash inflow in the investing section. That's why net cash from investing can swing wildly, often being very positive in some quarters. What about interest income? The interest income, MBS shows up in operating activities, not investing. Interesting. So positive investing cash flow doesn't mean earnings. It usually means they're shrinking their portfolio. Positive investing cash flow doesn't mean earnings. It usually means they're shrinking their portfolio, selling more mortgages than they're buying. Yes, or having lots of repayments come in. Why would it be strongly positive? The REIT is deleveraging, reducing leverage because rates are rising or funding costs are high. If mortgage prepayments are high, if they're raising cash for liquidity during a market shock, selling assets, very positive net cash from investing for a mortgage REIT usually means they're selling more mortgages than they're buying. The income does not appear in investing, it flows through the operating activities. Interest earned. The income interest earned does not appear in investing. Okay. Analysts often watch this as a signal whether the REIT is expanding or shrinking its portfolio in response to market conditions. So, what's this GPMT? So, looking, oh dear, capitals, doesn't matter, no point deleting that now. Looking at the most recent SEC 10 Q4 GPMT, would this suggest they are shrinking their portfolio? Second quarter originations acquisition, in addition to funding loans, totaled an outflow of 23.1 million. Proceeds from repayments of loans 188. This produced a net cash inflow. Loan funding were an outflow of approximately 10.1 million. Repayments brought in around 94 million. Net investing cash of 80 million. In the first quarter, okay, sorry, 6 months. What that means for GPMT's portfolio, given that both quarters show significantly more cash coming in from loan repayments and going out into new investments, it clearly indicates GPMT is shrinking its loan portfolio. Moreover, the company reported a net loan portfolio activity of 115.1 in unpaid principal balance, meaning the overall size of its active loan book decreased by that amount. Net loan portfolio activity. Why the investing cash flow doesn't reflect income. Key point, the investing section of the cash flow statement doesn't show interest income. It reflects loan-related activities such as when loans were made or purchased, loans repaid or sold, cash inflow. Thus, a strongly positive investing cash flow from GPMT simply means they receive more money from repayments or sales than they put out in new loans, not that they earned extra income. Interest income is captured in the operating section. Based on the most recent 10Q for Q2 2025, it's clearly shrinking its loan portfolio, as seen in both net cash inflows from repayment activity, unpaid principal balance reduction in Q2. So where's that? Unpaid principal balance reduction. What would that be in? This? Compensation. We're talking about cash flows, aren't we? So surely it's on here. What figures are they given? Unpaid principal balance of 115.1 million Q2, but this is for 6 months, so it's not going to split it down. Can't see it, but so how would you calculate whether an M-REIT is healthy? How would you calculate its cash flows? Might as well, we're down the rabbit hole of learning now, we might as well go on with it, haven't we? So, key metrics to focus on: book value per share. Since the market mortgages MBS to market, since they mark mortgages to market, BV tells you the assets are worth after liabilities. If book value is stable or growing, it's just managing interest rates and credit risk well. If it's shrinking, they may be suffering from spread compression, losses on sales, or asset markdowns. I haven't got book value on here, have I? The assets are clearly dropping off. The only problem we're going to have is this is empty, the second year. Net interest spread, core business model, borrow cheap, invest in higher yield mortgages. Formula: yield on assets minus cost of funds. Bigger the spread, the healthier the earnings power. Mortgage REITs often use 5 to 10 times leverage, too high risky if assets values fall. Healthy M REITs adjust leverage based on market conditions, dividend sustainability. REITs must distribute 90%, know that. Compare core earnings to be dividends paid. If dividends consistently exceed earnings, the payout is unsustainable. Yep, makes sense. Mortgage REIT's fund portfolio is mostly short-term repo borrowings. Look at cash balances, unencumbered assets, whether they have margin calls in stress markets. Healthy REIT is enough liquidity to survive shocks. What class is a liquidity though? Because is that the book value or what? How to think about cash flows. Unlike operating companies, a mortgage REIT's cash flow statement looks odd because loan activity dominates investing. Here's how to interpret it. It includes interest income earned and interest expense paid net of operating costs. This reflects the ongoing earnings power. Outflows, new mortgage loans or MBS purchases. Inflows, loan repayments, sales of loans. If inflows is greater than outflows, portfolio is shrinking. If outflows is greater than inflows, portfolio is growing. Financing cash flow. Inflows issuing debt, issuing equity. Outflows paying down debt, share buybacks, dividends. This section shows how they fund growth or delever. Putting it together, is book value stable or eroding? Are core earnings covering the dividend? What's happening in investing cash flows? How leveraged are they? Risk of blow up and stress liquidity. A healthy mortgage REIT has stable book value, sustainable dividend coverage, moderate leverage and enough liquidity. Calculate cash flows. They use SEC, okay, but interpret it differently than you would for a manufacturer. Loan activity dominates investing while interest income flows through the operations. Would you like me to build a step-by-step template with ratios and formulas you could apply? Yeah, go on then. Let's see what ChatGPT is going to do for us. So book value per share, price to book, earnings versus dividend coverage, core distributable earnings. How'd you calculate that now? Okay, core distributable earnings are usually reported separate from GAAP net income, use management's preferred measure. So is that going to be in the notes? There's nothing there. Is there? Hang on, dividends on preferreds. No, some people might be turning off on this point now, thinking this is boring, but it is something I'm interested in learning, so. I wouldn't know where it would be. Distributable earnings. Fair value, real estate loans. Accounting policies. Right. Yield on assets versus minus cost of funds. How would you work cost of funds out as well? Look at cash and encumbered assets relative to near-term obligations. Okay, this is raising a few more questions than it's giving answers. Grab equity, debt, cash flow statement. Thank you. Compute book value, compute book price of book. Check core earnings versus dividends. Compute net interest spread, often disclosing MD&A. Calculate leverage. Look at investing cash flows. Assess liquidity. Healthy REIT shows stable and rising book value. Dividends covered by core earnings. Reasonable leverage for its type. Would you like me to actually apply this template to, so you can see the numbers plugged into each step? Yeah, go on, because then that'll show us, won't it? Learning in real time right here. Book value per share $7.99. The press release notes book value accretion of 15 per share from share repurchases. Seeking Alpha reports a decline in 25 cents in book value from Q1 to Q2, despite internal accretion via repurchases. Overall book value decline quarter over quarter, likely due to portfolio markdowns or losses. That's a caution flag. Interesting. Price to book is approximately 0.2, 0.21. Price a bit well below 1 indicates the market is pricing with significant skepticism about book quality or sustainability. Not surprising for an non-agency mortgage REIT with credit exposure. That's interesting because they've got what? Was it $2 billion in earnings or assets? dividend coverage. Dividend 0.5p per common shares. Net loss 17 for Q2. Oh, wow. Core distributable earnings aren't provided directly, but given the net loss that exceeds the dividend, it's likely that dividends were not fully covered by earnings. Oh, interesting. Net interest spread, 6-month figures. Interest income, interest expense, net interest income. We don't have assets for yields versus funding costs separate, but the margin narrowed compared to 2024. How do we know that? Spread is compressing, reducing cushion for dividends or loss, especially critical given GPMT's shrinking portfolio. Modest and conservative leverage, much lower than typical, which that's good then. That's a stabilising factor, so that's one positive so far. Liquidity, unrestricted cash of 85 million, no corporate debt, maturities will remain in. Strong liquidity portfolio for the near term, good buffer in uncertain markets. Net loan portfolio activity negative, 115.1 million in unpaid principal. That's more repayments plus resolutions and new originations. This confirms shrinking portfolio consistent with strategic deleveraging and risk reduction. Overall assessment, strong points, low leverage, ample liquidity, deliberate portfolio reduction. Weak points, falling book value, dividend likely not covered by earnings, compressed margins. Go back up and read how they did that a minute. Dividend coverage, unsustainable earnings. They're just saying that dividend was more than net income. Conclusion, GPMT is in rehabilitative phase, managing risk, reducing exposure and preserving liquidity. Earnings do not yet support dividend durability and book erosion remains a concern. What you might monitor next, whether core earnings become positive or cover dividend, stabilisation or rebound in book value, any restarts in originations as market conditions improve. Would you like to pull key line items directly in a formatted spreadsheet or build this into a reusable Excel checklist? No. Let's just go back to the dividend coverage. Gap net loss, so it is, yeah. Is that right? What did they say it was? 17 million. Where am I there? Yeah, 17 million, so that is that. There, 17 million. Net loss due to common shareholders, 17 million. There you go, 35 cents. What's the dividend then? Where? Is the dividend only shown in, this is showing my inexperience again. Is the dividend only shown in the cash flow statement? Question mark. Dividends for any REIT show up in more than one place depending on what you're looking for. Cash flow, finance statement. Okay, statement of changes, stockholders' equity. Dividends also appears reduction in retained earnings. Interesting. Not in operating cash flows. Dividends never part. No, I get that. If you want to know cash actually paid. So, hang on. How do you know dividends exceeded net income? What lines specifically gave you this data? Right, so it is in the cash flow statement. Sorry, I was just having a big drink there. Reduction in dividends declared on common stock, stockholders' equity. That one here. It's interesting because I never actually read this one. This is the other part of the balance sheet, isn't it? When dividends declared. Yeah, so let's see it in there. Was it dividends paid on preferred? Dividends paid on common, that's 11. Or 12. But then the net loss was was 17 million, wasn't it? wasn't it? Isn't that what he's saying? 70 million negative plus 2.4 million positive. Dividends paid 2.4 million. Where did you find that? Cash flow finance, dividends paid 2.4 million. This is Q2. Can you do this again, but use the what would you call it? Q1 plus Q2 figures shown in the most recent filing. For 6 months there. Net loss 20 million. Is it 20? Three months, 6 months, net loss. I mean, this is saying it is 27, not 20. Oh, there. What's this here? Dividends on preferred. Oh, I see there, yeah. No, I got it. So why did he say 17 on the last one? Well, because it is, I guess. You got to pay the preferred before you pay the common. So what have we got here? Stockholders' equity, common dividends declared, totaling 5 million. Preferred dividends also declared 3.6, but these were separate from common stock. Right, GAAP net loss 20, common dividends declared plus. Well, I mean, it makes sense, doesn't it? You've lost 20 million but paid out 5. Net loss 6 months ending for GAAP is 20.378. That 20.378 is only on the common though, isn't it? Let's ask this question then. The 20.378 loss is only on the common stock. Should you be using the figure after paying the preferred? Net loss, income, preferred dividends includes everything earned by the REIT as a whole, less preferred stock contractually owed to preferred holders. Net loss contributed to common. This is already after subtracting preferred dividends, or it isn't. It isn't, not according to that statement. If you want to test common dividends coverage, bloody hell. Gotta ask, start a new chat. See, it isn't, because it literally says there, net loss income attributable to common stockholders. So you can't trust everything you read on with AI. Anyway, we've learned something, right, haven't we? Book value is key. And whether or not you're earning enough to pay the dividends key. And they're not. They haven't been for some time by the look of it. Which is why this has happened. Boom. That's a significant loss as well. Wonder what Let's see who owns it. That's the preferred, the second one. I mean, you'd be silly not to own the preferred. I was thinking something like this. Nobody is very confident on it. Look, 1.6 is the biggest portion of the portfolio. Who's got the most ownership for Vanguard? What was the other thing I was going to do here? %7 on the preferred, was it, by the look of it? Old. Not a compelling investment at the moment. Definitely not out of the woods yet. Granite Point's mortgage has improved liquidity, brings its 10% yielding preferreds into focus. 10%, jeez, and jeepers. Downside materialised, I'm flipping bullish. How did that work out for you in July 2024? I'm going to say not well. Well, it didn't for a little bit. You're at almost break even again now. This is interesting, isn't it? Because they own an awful lot. Potentially significant upside as well. I have to do some more research into mortgage REITs here, but we're going to have to start a new chat because apparently this new GPT-5 and you can only ask a certain amount of questions. Would you determine AM REIT was going to go bust? Balance sheet risk, debt to equity, very high leverage increases the risk, liquidity reserves, concentration, rising interest rates during neck. Watch for margin calls and repo dependence, check dividend sustainability. It's not sustainable at all at the moment. Yeah, it's the other thing. So you're going to have to look into the type of mortgages that they own. It's a bit deeper, isn't it, really, than just checking those metrics? Which obviously every investment is, isn't it? It's always deeper than just checking the key metrics. Are inherently sensitive to leverage, interest rates, and liquidity. Most dangerous ones show a combination of high leverage, poor quality assets, weak liquidity, and declining income or dividends. Watching the above indicators can give early warnings that trouble is brewing. Let's see what they say for a red flag. Yeah, checklist. Debt to equity, usually high. Heavy reliance on short-term borrowing. Low cash or liquid reserves. Interest rate and market exposure. Liquidity stress, frequent margin calls on repo. Selling assets at a loss to meet obligations. Okay, so that's other stuff you're going to have to look into on the notes and all that. Dividend red flags. Portfolio quality. Market sentiments. Rapidly falling stock price, definitely seen that. Management and governance, opaque and inconsistent reporting, aggressive shift in investment strategies. Weak risk management. One red flag alone isn't favourable. Combination of high leverage. Okay, if you want, I can also make a scoring system. Maybe another time. ChatGPT saves all your previous questions on here, so you can go back to them. Interesting though. Definitely learn a bit more. Definitely. Another income fund. What's this? Axon Enterprise. What's going on here? Load. That's a good investment. Look, tripled. I wonder what it did. Quick take spreadsheet. Where are we? Axon, literally Axon.
Not very good returns on capital. 300 years to pay off his blooming simple free cash flow, 59 billion. Wow, it's a big company. What does it do? Tasers. Really? Yeah. Wow. People with tasers are a $60 billion industry on one company. Who knew? 0% EBIT to EV. How does that work out? Oh, there you go, operating income of 1 million. If that's correct. Simple free cash flow is huge though, so I don't know if that is correct. Because you got 10%, haven't you? 0.3. Why do people love this so much then? And they love it. They truly love it. Look at that. I wonder. We had a reasonably healthy uptrend until this point. When was the US election? Because Trump was, there you go, November. Boom. Being pro-law enforcement. Potentially that is your catalyst. Wow, there we go. People certainly played that well, didn't they? If that's the case, I would say it probably is. When was the election? Get under the day. There you go. But that's election day. Close to it. Ways to play the election, see? Didn't even think, like, you wouldn't even think about that. Sure, that was it. US election 2024, 5th of November. There you go. Didn't see that coming. Waited as a way to play the election, but that's what it was. There we go. Wow. Well, for now, we'll leave this video there. Thanks for watching. I hope we learned something today. I certainly did. Yet again, haven't found anything to invest in, but Mary Ferrari, Lee Lu, Warren Buffett, Charlie Munger. You got to get good at saying no, and that's what all we've done today. So there we go. All right. Thank you very much, and we'll see you next time. Please like and subscribe. Goodbye.